Morning, welcome to Ainslie News this Thursday, 30th of July 2020. Of course, we're going to talk silver today. Silver, the cheapest metal on Earth. Sometimes you need a quick reminder of one of the key fundamentals rarely spoken about in terms of gold, silver, and Bitcoin's potential in an environment such as this. When a Wall Street heavyweight such as Paul Tudor Jones turned so bullish on precious metals and Bitcoin in May, it spread like wildfire in the press, and we also reported it. Tudor Jones talks, as we have many times, to the sheer asymmetric size of paper assets versus hard assets. He calculated there's around 300 trillion in paper financial assets compared to nearly 10 trillion in above ground gold and just 0.186 trillion of Bitcoin. We also reported that there's an estimated 0.87 trillion or 87 billion at today's price of silver above ground, according to the Silver Institute. Check out this next chart here from them, from the World Gold Council, just regarding global assets outstanding. As we raised in that linked article and discussed, there is a massive difference between above ground supplies and what is actually investable metal, and particularly for gold, what might be investable but not locked away by central banks and indefinitely long-term cultural holders such as Chinese family offices and the like. Indeed, the accepted number is around 1.5 trillion of gold. And so the key point to understand is that in Economics 101, three-parameter equation of price, demand, supply, when even a fraction of that 300 trillion tries to get into that tiny 1.5 trillion space, a space that can't be expanded with more supply, that just leaves one parameter, price. The tiny silver market takes that to an even more absurdly tantalizing equation. Just to put this further into context, consider the following chart from Crescat. Whilst the PM figure is on the business side of PM, or precious metals, not the actual metals, it's just another interesting insight into the disconnect between tech and monetary fundamentals. So this chart here from Crescat showing total market cap. We've got Apple on one side and the precious metal industry on the other. The likes of Apple and the rest of this tearaway NASDAQ have been buoyed by unprecedented new money searching for a home amid a recession. Tech, just like that little bubble you might remember at the beginning of this century, is easy to build, and it's different narrative around when looking where you might invest in equities. But that same free money is seeing bond yields in real terms turn negative, as we talked about in the second chart yesterday, and against which gold moves inversely lockstep upwards. Last night, gold rallied again on the latest US Fed meeting where whatever it takes was firmly reiterated. In other words, the printing presses will continue to go brrr. The market is again now pricing in negative nominal rates, so more deeply negative real rates referred to next year. Whilst in simple nominal terms, silver is looking to be halfway to retracing its $48 high in 2011, when you look at it in the context of being real money compared to that supply of new money, the USD fiat currency, you can see just how far off we really are in that retracement in the chart and tweet shown next. That's a pretty interesting chart there. Silver to money supply ratio from all the way back, it looks like, in 1980. I need to pause and zoom in on that one. But we are at the far end of that at 2020. For those guessing at charts, it looks like there's nothing but upwards to move. That's news today. Be sure to visit ainsleyBullion.com.au for all things gold and silver and for purchasing any of our products. And zoom over to ainsleywealth.com.au for all things cryptocurrency. We'll catch you tomorrow.